When you hear the word accounting, what pops into your head? Probably a lot of math, right? Spreadsheets, calculators. But what if I told you it's not really about math at all? It's a language. It's the universal language that tells the financial story of any organization, from your corner coffee shop to a huge global company.
So, what is the language of business? Well, that's exactly what we're going to break down today. Honestly, learning to understand it is kind of like getting a superpower. It lets you see the real story, the true health of any company you look at. And we're going to build up that superpower, one piece at a time. So here's our game plan. We'll start with how financial stories are even written down. Then, we'll learn the absolute core grammar of accounting. After that, we'll build up our vocabulary with some key terms, figure out how to handle the messy stuff like returns, and finally, we'll put all those pieces together to see the incredible insights you can get.
All right, first up, the art of financial records. Before you can speak a language, you've got to know how the words are written down and kept in order, right?
Okay, so it's super easy to get bookkeeping and accounting mixed up, but they're actually two totally different jobs. Just think of it like this. Bookkeeping is the act of writing the story. It's the day-to-day work of recording every single transaction. For our little coffee shop, that's noting every latte sold, every bag of beans bought. Accounting, on the other hand, that's the art of reading the story. It's taking all those notes, classifying them, and figuring out what it all means. So one writes, the other interprets.
Now let's get into the core accounting equation. If bookkeeping is the writing, then this equation, this is the fundamental grammar. It's the one single sentence structure that the entire language of business is built on.
The first part of our sentence is assets. This is pretty straightforward. It's all the valuable stuff a business owns. We're talking about physical things like buildings and furniture, sure, but also the cash in the bank or the inventory of products on the shelf. For our coffee shop, the assets are its big espresso machine, the cash register, and all those bags of beans just waiting to be sold. It's everything the business has.
The next piece of our equation is liabilities. These are all the debts and obligations a business has. To put it simply, it's what the business owes to other people. So maybe our coffee shop took out a small loan to buy that super fancy espresso machine. That loan, that's a liability. Same goes for the bill from the supplier for all the milk they delivered this week.
And the final piece of our puzzle is capital. This is the owner's skin in the game. It's the money that the owner, the proprietor, personally invested to get the business off the ground or to keep it running. It's the cash our coffee shop owner pulled from their savings to open the doors in the first place. This represents the owner's personal claim on everything the business owns.
And here is where the magic happens. On one side, you've got the assets, everything the business owns. And on the other side, you've got everyone who has a claim on those assets. That's the liabilities, what's owed to outsiders, plus the capital, which is what the business technically owes back to its owner. These two sides must always balance. Always. That's the one unbreakable, golden rule of accounting.
Okay, we've got the grammar down. Now it's time to build up our vocabulary. In this section, the vocabulary of transactions, we're going to learn the actual words that describe all the action happening in our financial story.
So, modern accounting runs on something called a double entry system. It sounds complicated, but the idea is simple. Every single transaction has two sides to it. It affects at least two different accounts. It's not just that our coffee shop spent money on beans. The story is that its cash, one asset, went down, but its inventory of beans, another asset, went up. See? Two sides. This is what keeps that main equation in perfect balance, all the time. Let's nail down two key roles, debtor and creditor. A debtor is anyone who owes your business money. A creditor is anyone your business owes money to. Let's say our coffee shop delivers coffee every morning to a local office and sends them a bill at the end of the month. That office is a debtor. And the dairy that supplies the milk and lets the shop pay later, they're a creditor. Simple, right? You collect from debtors and you pay creditors. And here are the two most basic actions in business. For our coffee shop, sales are all the money it brings in from selling its actual products, the coffee, the croissant, you name it. Purchases, on the other hand, are when the shop buys the stuff it needs to make those sales, buying the beans, the milk, the flour. So one is cash coming in from happy customers, the other is cash going out to suppliers to get the inventory.
Of course, business isn't always a straight line, is it? Things get returned, prices get adjusted. So next up, let's see how accounting handles all of that.
So sometimes stuff comes back. If a customer brings back a bag of coffee beans they bought, that's a sales return.
It's sometimes called a return inward because the goods are coming back into the shop. Now, if the coffee shop gets a faulty milk frother and sends it back to the supplier, that's a purchase return, or a return outward, because the item is going out of the shop. See, they're just perfect mirror images of each other.
Prices also change, and the language of accounting has specific words for why they change. A discount is just a general price cut, like a 20% off all latte sign in the window. A cash discount is a little different. It's a reward for paying a bill quickly. Maybe that office with the coffee tab gets 2% off if they pay within 10 days. And an allowance? That's when you get a price cut on something that's slightly damaged, but you decide to keep it anyway. Say the shop's new display case arrives with a little scratch, and the supplier knocks $50 off the price. Each of these words tells a very specific story.
All right, we are in the home stretch. We've learned the grammar and the key vocabulary, so now it's time for the best part, putting the pieces together to see what kind of powerful insights we can actually create.
And here is where it all pays off. We can combine some of these concepts to figure out a really powerful number called working capital. All it is the excess of current assets over current liabilities. Now, don't let the word current trip you up. It just means short-term stuff, assets that can be turned into cash within a year, like the shop's cash and inventory, and liabilities that are due within a year, like that weekly milk bill.
The formula is as simple as it gets. Working capital is just your current assets minus your current liabilities. So why is this so important? Because this number is like taking the pulse of a company's short-term health. It tells you if our coffee shop has enough cash and resources right now to pay its baristas and cover next week's order of coffee beans. It's the money available to run the day-to-day operations. A positive number here, that's a really, really good sign.
So we've gone all the way from just writing things down to calculating a key financial metric. We've seen that accounting isn't just about crunching numbers, it is a powerful language that tells a story of success, of struggle, of risk, and of opportunity. So the real question is, now that you know the basics of this language, what stories will you go out and uncover?